Right. Welcome, everybody. What a week this has been. What a week this has been here. So it's quite the week in the stock market. I've hopefully been watching. Um, hopefully, you've been watching the market outlooks this week. Brandon did a really, really good job last night, as he always does. He always does a really good job. But it's been quite the crazy week, and it's I think it's been good to it's been a good opportunity here the last couple of weeks just to kind of say, okay, you know, this has been like a little bit of like manic trading in terms of like the broad market as a whole. Now, granted, the day's not over. We could end up negative and might not be the most horrible thing. We'd have a long upper shadow instead of a long lower shadow on the futures at least. Um, and that's not as bullish as a long lower shadow, but again, I just hate the overnight move. We actually limited up last night. We limited up last night on the futures contracts, um, and I know I just do not like that. I do not like that. I would have preferred that we kind of settled down last night with like a 1 or maybe 2% drop to open the day, and then to have the 5% rally with volume instead of having a 5% rally without volume. Those are really weak. 5% big moves overnight, big up moves overnight are just really, really weak. You need big moves during the day, right? Big candles. That's what you need is big candles, and a move like last night doesn't lead to big candles. So, as you all know, more often than not, gaps get filled, and that's the issue. Common gaps, at least. Common gaps get filled. So, when you look at like here, you got this little gap pattern. Here it's. Oh no, you can't see me. Here, let me share my desktop. Here we go. All right. All right, so there we go. So common gaps get filled, and that's a common gap. I don't think that even that's a runaway gap. Now, granted, had we rallied off of the open, then I would have felt better about that even being a runaway gap. And a runaway gap, remember, don't get filled in. So there's two different types of gaps that don't get filled in. There's runaway gaps and there's breakaway gaps. Obviously, we're not going to be breaking through resistance anytime soon. But at some point in time, we will stop the selling and rally, and so that's a runaway gap, right, where we turn around and start an intermediate run to the upside. Doesn't necessarily mean that we'll have a 3-month intermediate run, but enough to get the intermediate line back above 50, maybe not above 80, but above 50. That would generally start with a runaway gap, a gap that doesn't get filled in. Usually stuff like that, gaps like that start off with a gap, a pretty decently sized gap usually, and then we just rally from the open, right? That's kind of how it's a runaway gap, kind of similar to this, where we went down from the open, we retested, but we didn't fill in at all any of the gap, and we just continued down. That's a runaway gap. In this case, going to the downside. So we, something similar down here would be what we'd be looking for. And obviously today, and I didn't think today was, we're not going to get a runaway gap anytime soon. It's going to be a little bit of time before we get a really good intermediate run going, right? Like I said, and the next intermediate run we get, most likely we'll just get the intermediate line above 50 on the market forecast, and then the green line, and then be done, right? And then pull right back down. That's kind of what I'm expecting. I do expect this volume gap to get filled in because there's a gap right there. And so now you can see where the volume is on SPY, like right here about 275. So there's going to be some resistance there, right? And at, maybe we might fill in this gap, these two gaps at some point in time here relatively soon to the midpoint of the range. But more likely than not, we'll fill in this gap, and that's going to probably be about it for now, at least, on any kind of short-term bump, and that would get, that kind of what we're looking for there is just to get the near-term line above 50. Right? You can see even with today's move, and we're up 3%. It doesn't look like a 3% move, but even with today's move, that would be, that would only, you can see how far down the near-term line is. So just getting it above 50 would kind of feel pretty good, wouldn't it, Joe? Like the blue line, much less the green line. But that's kind of what we're looking for. And keep in mind when you're talking about, keep in mind this too, when you're talking about this extreme bearishness that we're having. Let me go back to here, and let me go back 3 years. Keep in mind when you have this extreme bearishness, and we kind of had it right here in October of last year. We had this big move to the downside, and then we went down even further. And it seemed really extreme at the time. Obviously nothing like this, but it seemed really extreme at the time. And you got these divergences here. Right? You see the higher lows. Right here. Right here, you see the higher lows there and there. And then obviously with much lower lows here. So, you notice a very similar pattern developing here. But the difference is, and again, that was an extreme. Like we went down from, what? At one point, we were down 10% in a few weeks, 21 bars, so 4 weeks. Not as extreme as we are now, but we were down 10%. And you notice that, we rallied right back up to the high point in between the lows. You see that? Right back up to the high point in between the lows there. So okay, you look at this. Look at this, and you say, okay, down here, there's the lows, there's the divergent low point, and you notice here's the high in between, right? And that's a pretty decent sized move to the upside. That would be all the way up to back to 3,100. And again, how likely is that to happen? Well, it's as likely as that bounce was to happen right here. That wasn't very likely. Things were really extreme for the time back in October of 2018, and then we bounced up really sharply there. So we'll see. If we move back up, and I don't think it's going to take a while to get up to that level. And you can see when we got up to that level, we weren't done. We retested lows again. So if we get up to this level, I don't know if we'll come all the way down to 2,500, but we'll retest lows again if we get up to that level. Again, based on this divergence that we're having. But if we got up to that level, you can see that. So it would be right this high point. We'd be filling in all these gaps, essentially up to this 303 level, which is where the point of control is right now. So we'll see. We'll see if that ends up happening. I would be, I think the market itself would be thrilled if we just filled in that gap right now, back up to 275. So I think there's a possibility the president shuts down the market. I mean, 9/11, we shut down the market in 9/11. The difference with 9/11 is we shut down the markets, and then once we reopened, the selling occurred. All right, so that was the last time we had an extended period where we shut down the markets. Just to kind of give you an idea of what that looks like. Well, the options would shut down too because they're derivatives of stock price. You can't, options prices can't, and their expirations would still be valid there. So you'd have to, I mean, that's a risk, right? You go back to I'm sure they would have some kind of language to let people know what's going on and how it works. But let's go back to so this is why this is why I don't necessarily think that we're going to have the options, the stock market close. I don't think that's going to be an issue here. Is when you go back here. So here is here's 9/11, right? You can see we were already pretty bearish. Where are we at? Over here. We were already pretty bearish going into 9/11, right? The market was up. We were already in a death cross environment, so it's a little different scenario. We were already in a death cross environment in 9/11, in 2001, in the fall of 2001. So death cross environment again is 50-day moving average is below the 200-day moving average. So basically a long-term kind of bear market. We were in a bearish intermediate run, so we were already coming down. The green line was coming down and was low. So we were pretty much bearish regardless of 9/11. Then 9/11 happened, and they shut down the market, and you can see on the 17 how it came all the way down, like we fell down. The worst of 9/11 occurred after, right? And then after options expiration, we took off like a rocket off that low point. The difference between then and now is we're not in a bear market now. So there's not, there was already this kind of, excessive bearish sentiment momentum. That wasn't the case here. The worst selling occurred afterward. They shut it down to kind of keep the worst selling from occurring. The worst selling here has already occurred. So, I mean, if they were going to shut down the markets, they should have shut it down, last week or something, and give it some time for Corona to avoid, all this selling. So it's kind of hard. It's, the worst of the selling has already occurred. And they didn't shut it down in 1987 either. So keep that in mind. They don't always just shut it down like that. And then, so they didn't shut it down then. And then again, we rallied after the worst of the selling, just like in 1987, we rallied. So that's, it'll be, I expect at some point in time, there will be a little bit of a rally here. Whether we get up to 3,100 or not, it's a different story. That you do got this low point that you have. First of all, you have just the little resistance here on the gap. You have that little bit of resistance there on the gap. If we do rally here up to 275, so you can see there's an obvious resistance there. But they can trade electronically. So they don't have to shut it down because New York City is being shut down. They can still trade electronically, and they can still get to the floor. They're like, people are still working. Not everything is completely, it's just the gatherings that are shutting down. So they might not let people come to it, like people who don't work, like essential personnel or something, but they don't necessarily have to shut it down, so to speak. So, yeah. Well, that was a different, that was a different story too for them. And we weren't in a bear market, and there was an extreme amount of selling, and that's a little different in that regard. And that is the issue, the data issue. The market does not like uncertainty, and that's what the market's getting is uncertainty. And that's why I think I think negative headlines are still out there. I think there's an opportunity for negative headlines still in terms of like a lot more infections, right? Confirmations of infections. That's out there and that's coming. But keep in mind that that's also certainty. The market just doesn't like uncertainty, and that's what the market is coming now. Like, there was uncertainty about whether the NBA would play. There was uncertainty about this. There was uncertainty about whether the tournament would go on. There was, I mean, these are like, I know these are athletic events, and some people don't really care about that, but they're also pretty significant economic events, especially in those cities where they take place, and so a lot of these events too, what even like conferences and such. There's a CMT conference for technical analysts that they usually do in New York, and I was kind of considering going, and I wasn't too on board, and now I'm kind of glad I didn't, because I think they're gonna cancel that conference. Everything is kind of being canceled, and there's an economic impact on stuff like that. But now we have certainty. Chartered market technician, country music television on one hand, Linda, and chartered market technicians on the other. Yeah. I mean, that's going to be a hard thing for some industries. There's some industries that are going to be hit harder than others, and that's kind of the industries that need to be helped the most, especially the ones. I'm not too worried about the cruise industry. They can figure themselves out. I mean, there's always inherent risks in the cruise industry for any illness, much less the coronavirus, because of the nature of the situation. But like the airline industry and travel industry and tourism and things that have significant impacts on local economies, that's a huge deal. Yeah, I've rolled that sucker a couple of times because I don't know how much longer that's going to last. That's going to, these are big deals for the markets to, but again, the nice thing is we have certainty now. Like, we know what's shut down. Now the next level of certainty will be how many people are infected, and even if it's a large number, again, there's a lot of faith and confidence in the healthcare system to be able to handle it. I think the problem is the uncertainty of how many people are infected. As numbers come out and we get more and more certainty, you'll see things really settle down in the markets, even though everything is shut down, because now there's no uncertainty about whether things will shut down, right? There's no uncertainty. That's been the problem. There's been uncertainty about whether things will shut down. Now we know what is being shut down, and the market can price in the impact, and that's what this has all been, right? This is. I had this discussion yesterday. The markets, when technical analysis is not a bunch of voodoo, and that's why you're in this class, right? This technical analysis is not a bunch of voodoo. The markets will price in this case, right? The markets will price in worst case scenario, right? They're not pricing in what information they get. They're pricing in expectations. And in the case of uncertainty, the markets price in worst case scenario. And that's what you should do too, right? When you make a trade, don't you position size for worst case scenario? Right? You do it. The market does it too. The market prices in the worst case scenario. So once the news starts coming out, whether it actually matches the worst case scenario or not, you can see how now that can provide lift for markets. Again, now if things come out worse, which is kind of hard because again the market always tries to price in the worst case scenario. The market just lost from, in the last 4 weeks, in fact, in less than 4 weeks, the market just lost 25% of its value, right? One quarter of its value. 27%, more than a quarter, almost a third, right? In between a quarter and a third. In less than 4 weeks, then more than a quarter of the market's total value has been lost. I mean, think about that. That is worst case scenario. That is the market pricing in worst case scenario. So now, as news starts coming out, that things are, whatever it is, right? Again, because I think the first batch of news regarding infection numbers will be relatively large because they'll start testing people. If for example, if I got sick right now, or my wife got sick, we would, let's say we got a little bit of a fever and we got sick, and we wouldn't go to the hospital. We would, try to get lots of water, drink, and try to be healthy and try to get over it. And maybe we do have it, the coronavirus, and again, because we're relatively younger and we're not in the demographic that's, at risk demographic. I've got some lung issues, obviously, and you all know that, but I'm not, if I get the coronavirus, we're not worried about dying, so we're not gonna go. So we might have it and not be accounted for as somebody that has it, and we might just get over it. Like, what they say, 80% of the cases are mild. So if that's kind of the idea, is like the numbers could be a lot worse. But I do think that the first numbers that come out will be large because we'll start testing people that either didn't care really to be tested because they'll just feel like they get over it, or they're just curious, right? They get tested, they're sick, and they're curious. And I mean, really, like if I got sick and I went to go get tested for a coronavirus, because I would be self-quarantining myself anyway, just like you do normally, then if I got sick, I would if I got tested, it would be out of curiosity mainly only. So keep that in mind. Like that's why I think the initial batches of numbers will be, and they'll be relatively large. The numbers will be relatively large, and that will be okay, right? Because again, a 27% decline in stocks shows that that the market is expecting a lot of people to have it. The market was expecting everything to fall off the table. The market was expecting everybody to shut down. That's what happens when you sell off more than a quarter of your value in less than 4 weeks, essentially 3 weeks. So once things shut down, the market's like, okay, we expected this. Once these numbers come out that a lot of people have the coronavirus, the market's going to shrug it off and say, we expected this. And if anything, there might be an initial knee-jerk, right, where we sell the news and then just get that long lower shadow and pop back up, if that makes sense. That's how technical analysis works, right? And it's these big kind of bearish moves, the market is always pricing in the worst case scenario, and then we go up from there, right? Then we go up from there. So once the actual scenario plays out, and more often than not, the actual scenario plays out ends up being not as bad, right? And that's kind of what I expect here, only because of past experience, not because I know anything about the coronavirus, but only because of past experience with markets that and news and sensationalism and all of that. That once things start coming out with coronavirus, it will. I personally believe it won't be as bad as what we're all expecting it to be. It might still be bad, but it won't be as bad as what we all expect it to be, because the media kind of paints a picture that's worse than what it actually is. Simply, and again, I know I'm not an anti-media guy, because otherwise I wouldn't know what's going on in the world. So I'm not an anti-media guy, but I do know that that's their business model. Their business model has always been, from the beginning of time, to get people to pay attention, and people don't pay attention unless it's dramatic, right? They don't pay attention to little small town hero stories of the firefighter rescuing the cat out of the tree. They pay attention when the house burns down. That's when everybody comes over and pays attention. and that's just the reality of a business model, of that business model. So because of that, I think, and this is David Settle speaking, I think the market has priced in a really, really significant worst case scenario, as it always does. And once this scenario comes out, it will be relatively bad, but I don't think it will be as bad as what we all think it will be. I think it will. I mean, it's already settled down in China. It's already settling down in other areas. It's having a hard time, like in Italy and in Iran, but there's reasons why it's having a hard time in Italy and Iran that we don't have to worry about, right? That we don't have to worry. Even in Italy, we don't have the same issues that we have to worry about as they do in Italy. So I think it will settle down. I think it will settle down, and then we will. And again, when the VIX has been this high, as I tweeted, did you see that tweet from last night? I tweeted out a bunch of stuff last night. And it was relatively late because I was awake and going, but hopefully you saw that here. I tweeted out a bunch of stuff, and Brandon's been tweeting out some really good stuff too. So hopefully you're following us on Twitter. Here's the linear regression trend lines. This is the 1 year. This is after yesterday's close. The 1 year, the 5 year, and the 10 year. So what that means, it doesn't necessarily mean that we're going to bounce, but what that means is we got a pretty decent margin of safety here because we're already so extreme to the downside. We got a pretty decent margin of safety. I also tweeted out, let's see here, this right here. So this date is the last time. So when the VIX rallied during this sell-off in October of 2008, this where my line starts over here on the left, that was the first day that we crossed up above 70. Now, it wasn't the last day we closed above 70. That was actually over here. So it wasn't the last day we closed above 70, but I hate when people do that. I hate whenever they say, well, this is the last time that the VIX was up above 70, and then they go back to when it was coming back down below, So this is where my cursor is the last time that the VIX crossed up above 70 on the first time, and it stayed above 70 for a few days. So similar to now, this was, this period over here, right now, yesterday, it was the first day yesterday that we crossed up above 70 on the way up, not on the way back down, right? So trying to be apples to apples there. Well, from that date, including this 20% plus drawdown, including that 20% plus drawdown there, from that point going forward, the S&P was up 20% a year on average for the next 5 years. So think about that in terms of risk appetite, right? Again, including this 20% drawdown, it was up 20% a year. To kind of show you what it looks like from this asset class comparison chart, you go to 10/24 of 2008. Why does it do that? Of 2008 to 10/23 of 2013. Okay, so again, including this drawdown right here, where we were down, look at that, 20%. We were down 20% there. Preferred stocks really got hammered. Crude oil was hammered going into that July. From that point, again, 20% a year for 5 years, on average, is what the S&P did. And you can see, even gold rallied during that time because the dollar was so bearish here. Crude oil didn't really rally, but the dollar was so bearish, so emerging markets really rallied. Gold rallied, even though we were really bullish in terms of risk appetite. Small cap stocks really rallied big time, and you can see REITs. This was REITs, and that's the they were really hammered during the the bubble bursting. And then you look at the sector comparison here, and you do the same thing to see, okay, well, what sectors rallied up higher? 08 to with a weak dollar. I mean, those consumer discretionary did really well. Industrials did really well. Technology, energy stocks rallied up. Materials, I mean, all your technology. Where's the financials? There's your financials. They struggled, kind of lagging behind. They were really beaten up. So this is the financials now or the financials then would be energy now. So I wouldn't expect energy to get to this level. Right. So I'm reading the chat window about those expectations. So keep in mind that the market's expecting even worse than that. Always, whatever your expectations are, the market expects worse. That's what the market prices in, because fear is a lot more powerful emotion than greed is, right? So whatever our expectations are, the market expects worse and has priced in worse. So keep that in mind. All right. So data represents certainty, and the lack of data is uncertainty, and that's why the markets are so bearish, right? So once data comes out, no matter what it is, it represents certainty, right? Just like, again, the NCAA and the NBA shutting down, which was a question mark for the last week, was uncertainty. And now that they are shut down, which would seem to be really bearish, now the markets are like, okay, we priced that in. We're okay. The market can figure that out now because it's certainty. Even though it's the bad news, it's still certainty. And that's what the market cares about. Here's this is all the sectors and how they performed during that 5-year rally since the VIX crossed this level. And also keep in mind that the things have changed. So you'll have communications in here now. Because that would be your Facebooks and your Googles and your Netflixes and things like that would be and Disney would all be in the communications sector now. So the fact that the VIX is up is actually a really, really good thing. Really good thing here. It's going to depend. It's going to depend upon the risk that people will be taking. It's going to depend upon what kind of stimulus gets announced, if any gets announced here today. I would actually prefer that we don't. I would prefer that we close at the low of the week, and then turn around and have a big bullish candle next week. That would be the more ideal scenario, because I don't want to have a big long lower shadow here this week and then trade within the low points next week. Right? Yeah, I'd actually prefer kind of the close at the worst case scenario. Right? Worst case scenario. Yeah, if we got the VIX up, the VIX is up again. If we got the VIX up to like above 80, and that's where we close the week, that would be, again, look at this chart and go back to way back over here too. Go back to, and that's a monthly chart. It's the same idea. So go back over here. Even over here. Here's our close above 80, and that even still had a long upper shadow. But look what happens when the VIX, again, look at the red candles versus the non-red candles. Or I guess it's not just red. Look at the filled-in candles versus the open candles. The filled-in candles versus the open candles. And you can see, even during this period of volatility, right, when we broke up above 30, this kind of 35-ish level, when we broke up above that, once we really filled up, once we really broke out, yeah, there's a lot more filled in, isn't there, Robert? a lot more filled in, and this is a weekly chart, mind you. So this isn't just a daily chart, which we already knew that because that's a very common principle with options inventory trading. But here on this weekly chart, it's the same thing. So yeah, I mean, and there's long upper shadows. So here we are breaking through, and we had a couple long upper shadows the past couple of weeks. If we close at the high this week, there might be a longer upper shadow, but do we think that the VIX is going to close up like this and then have another big large candle and close up above 90 or 100? Right? The likelihood is very low, very, very low. The likelihood is when you get this extreme move in volatility and we close at the high of the week, let's see if we can, because there's so many long upper shadows, it's kind of hard to see. You can see, like, for example, right there. I mean, it wasn't at that big of an extreme move, but, I mean, that was an extreme move, and we did go up to a longer upper shadow eventually, but the very next week, you can see we fell down. It wasn't filled in, but it was a significant drop that we dropped all the way back below 30 after we closed the week at the high of volatility. Here, this was the August of 2011, and we got the long upper shadow there. Here we kind of closed at the high of the week, and we came back down. See if I can find another. See, here's 2008, and it's just hard to see in 2008 because we got the long upper shadows there. But we got up to this 80 mark after a couple of weeks. We got up to this 80 mark, and boom, 2 weeks we were down. Volatility was down pretty sharply. It bounced back up, but we went up and we came down sharply after we closed at the high levels. We don't have any more here. So yeah, if we close up here, that would be really, really, in terms of like volatility dropping next week, that would be really nice. Right? It might not take until the beginning of the week. Beginning of the week, Monday, we might get a move higher and then come back down. This is the weekly. Look at the monthly. Let's see, when was the last time we closed a month? So we're in the middle of the month, March 13th. Let's see when the last time we closed a month at such a significant high point. And we'll go back as far as we can. To this, okay, we'll go back as far as we can. So there's a bad month in August of 15. You see how we didn't close at the high of the month? Here's a bad month. August of 2015. Did I already say that one? Did I say that one? Yeah, I did. August 2015. There's a bad month. August 2011. You notice we filled in the range. And here we did close at the high of the month. And look what happened right after. Here is 2008. October of 2008 did not close at the high of the month. And look what happened after. This is the flash crash, May 2010. They did not close at the high of the month. Came down. A couple of pops here in September 11. We did not close. 9/11. We did not close at the high of the month. July 2002, that was the big move, the big extreme move that ended that bear market. Did not close at the high of the month. Still traded within the range, but didn't close at the high of the month. This was the last time, August of 98, the Thai bought the currency crisis that we had, the long-term capital management, that really, really bad time in the markets. We did close because it happened at the end of the month. So we did close at the high of the month. And look what happened immediately after, right? So, and then, of course, over here, here's 1987, October of 1987. Obviously, we did not even come close to closing at the high of the month. And then you can see what happened after. So I don't expect us to close at the high of the month here on volatility, which means we're going to get a big jump and a big drop in volatility, most likely by the end of March. Keep in mind, like, I just from an anecdotal standpoint, like a lot of things here in Utah that are shutting down, like schools and activities and things like that, they're shutting it down until the end of the month. Like, you see, at least in our area, there's a lot of, we're kind of reevaluating at the end of March to see how things are going to look like in April. So by the end of March, like if we get all these things that are shutting down and it starts looking more and more likely that we're going to start reopening things in April, like China has been doing over there, then you can kind of get an idea of how that would start to be a positive thing for the markets. Let's go to this really quick. Where is, I need to look at this one. Okay, and then let's go over here when things really started hitting the fan. So January the 17th. For China, right? So things really hit the fan in China, and they were the worst. South Korea too, right? They were the worst. And then you remember that China came out with all that stimulus. Remember that week where we rallied so hard, and I told you it's like, it's so, not to really trust that rally because most of the gains occurred in overnight trading. Remember that week where most of the gains occurred in overnight trading, and it was like, don't trust that rally. And obviously, nobody expected this big of a move, but, obviously that rally didn't last. But China and South Korea, they were the worst initially. That on that initial bout of coronavirus, how it was impacting, and they were shutting things down, right, over there. All right, well, from that worst, here's January the 31st of 2011. 2020. I don't know why I said 2011. So from that, with all that stimulus, they shut things down, right? And they did a big basket of stimulus. And look what happened. On the rally, look who gained the most. On the rally, look who gained the most. China and South Korea. They gained the most during that rally. Okay, well, once things hit the fan here in the U.S. was 219. So we started to shut things down right here. Started to be a significant impact. Look who's doing the best. They're still down, so it's not like they're like gaining. But look who's doing the best here. Who's holding up the best? China and South Korea, right? So, and we're following the same pattern. We're following the same pattern, shutting things down and having, that fiscal stimulus. Like Italy, though, Italy is struggling, but we're not Italy. I've always said that. You've always heard me say that. I've said it a lot, especially in my portfolio management class, that Italy is like the emerging markets. Italy is the emerging market of Europe, right? Italy and Spain, more Italy than Spain. But Italy is like the emerging market of Europe. We're not China either, but we're following that playbook, the playbook of shutting things down. We're shutting things down. We're not making everybody go home. We're not making everybody go home from work. People are still working. But we are essentially shutting everything down to settle things down. And we're going to pump out a lot of stimulus here. You'll see the Fed's already pumping out stimulus. They're going to pump out more because they're going to cut rates down back to zero. More likely, they're going to cut things back down to zero. There's going to be a big fiscal stimulus package going forward from here. Whether it's here in our household, we're kind of rooting for the no payroll taxes and for this next year, and we're rooting it. And that's going to happen too, right? So that will happen here too. We all know it will. We might not have it now, but it will. We'll start testing people and getting that, and that will settle things down too. And so, keep in mind that China didn't have the data. At least they didn't release the data. for weeks. I'll keep that in mind. So it will happen and things will settle down. And the market has priced in the fact that it won't. The market has priced in worst case scenario. And how often has worst case scenario actually played out? Not too often. Not too often. Usually things settle down, and they will. It will settle down here, and we'll get it. And we'll. I mean, this will be a tremendous bull market because of how big the sell-off has been. This will be a tremendous bull market coming out of this. Always has been in the past. Always will be going forward from here. Because the story arc is the same. As much as we want the story to be different this time, right? As much as we want the story to say, and I agree with that too, Clarence. As much as we want the villain to win at the end, the story arc with the hero story arc, right? As much as we want, hey, sometimes the villain wins in the end. Nope, that's not how the story works, right? The story works. It's a hero story. So, it's the story. We're all humans. It's the same thing. We have the same emotional reactions to things. It will eventually, we will come out of this to the upside, as bad as it is right now. And the nice thing is, the worse it is. I mean, shoot, I was hoping for just an intermediate pullback, right? I was hoping for an intermediate so we can get a good, a couple of months rally into the May. And if you recall from my portfolio management class, and now I'm going to show you an indicator here, what kind of was the topic of the day, but if you recall from my portfolio management class when we started, yes, Phil, he did. He's eventually going to go to Omaha. When I started the portfolio management class, my long-term expectations were really low, right? If you remember that, even though I thought the markets were bullish, like right now, like in 2019, I was expecting the market to be bullish. I was expecting, 2020 to be bullish. But I was expecting, because my long-term expectations were low with high valuations, what that meant was that I was expecting a kind of this extended bear market to really bring returns down, so that the long-term returns were low. And usually it's just like a one big kind of pill to swallow that would do that. So what I think right now is, I think since the beginning of 18, in fact, when I said that was April of 18 when we started our classes, since we started tracking that portfolio, our benchmark, I actually think that we have been in a bear market this whole time. And that was a great chart, Clarence, that you sent out. For those who didn't see that, again, I retweeted it. And if you follow Clarence too, where was it? Where did it go? Here. Clarence put this together and tweeted that out. This is amazing, right? This is the S&P 500 in black. This is the S&P 5. This is the FANG, that these $1 trillion market caps. Facebook's not quite, but it's the biggest one outside of the $1 trillion market cap club. But this is the $1 trillion market cap club that's been around $1 trillion plus or minus a little bit, and then Facebook. So the 5 biggest market caps in the country. That's how they've been doing. That's the S&P 500. This is the S&P 500 without those stocks. So the S&P 495. This is the S&P 495. I mean, isn't that fascinating? We've been in the bear market, and we just didn't know it. Yeah, SPX is market weighted, so yeah. We've been in the bear market, and we just didn't know it. And the reason why we didn't know it is because of these $1 trillion market cap stocks that were pulling us. They were being pulled towards that big market cap, and that brought the whole market. I mean, that brought the whole market up with it, because S&P is market cap weighted towards those. And that's what I tweeted out. I tweeted out here This one, see, not, is it this one? Um, yeah, this one. I tweeted out here that, so there's the period in question. So there's the period. This was the end of that bullish run. Look at technology. I mean, so during this last rally, where the market went up, and the rest of the S&P did not, but look at that big rally in those FANG stocks, right? So that period, right, that those are in this period in the market, that last bullish, right before this coronavirus. That's when the coronavirus hit. There's those big gaps that were overnight. Well, look, besides utilities and real estate, which is a safety trade, and very, very small components of the S&P 500, very low market caps, technology, communication services, and discretionary. They pulled the S&P up because they're so huge. Microsoft and Apple, communication services, Google and Facebook, and discretionary is Amazon. Those are those 5 stocks. Pulled the market up. All the other cyclicals were flat at best, and energy was really down. And then you look at the asset class comparison. During the same period, gold, utilities and real estate were up. So was gold. So was bonds. So was real estate, and the dollar. Everything else was down. Equities were all down, and crude oil really down. So I mean, that was a great look at this idea that we've been in a bear market. We just didn't know it. We just didn't know it for stocks. And so it's played out. You can see, look at the sell-off here. The sell-off here, there's not very much of a sell-off down here and a big sell-off of those. So that's what's happening. That is what's happening. Right? We're just correcting that this divergence of these stocks away from the rest of the market. That's what's happening right now. And it was such a big divergence that it's so big. Okay. All right. So yeah, I mean, if we finish around this is an inside the day. This would be now if we finish down below 2450, that's a different story. I don't know how much I would like that, but I would prefer us to stay right here. This would be ideal. This would be a very, very ideal pattern here. Finishing at the high of the week in volatility, getting an oversold cluster, like someone mentioned up there. With a Harami pattern here, a little bit of a long upper shadow. It'd be even more ideal if we kind of close, closer to the open, so the body is a little bit smaller. And we very well could do that, right? We might rally at the end of the day into the close. We might rally into like right around this 255 level. So we'll see. That would be kind of the most ideal. Then we'd have a smaller body, even more of a significant Harami pattern playing out. And like I said, volatility would finish at the high of the week. And that's, that would be. And I mentioned too on Twitter, yesterday's volume was a 5 standard deviation move in volume. That's a 5 standard deviation move in volume, and we're headed towards it again today, right? You see how we're headed towards a pretty decent amount of volume today. Yesterday's volume was, 392, and if you look at today's estimated volume, this is also a clearance study they put together, we're estimated at 375 right now. So we are pushing for another day of an extreme amount of volume. That's right up into there. Okay? Another extreme amount of volume, which will mean that this week's volume will end up being pretty darn extreme. Right? Pretty darn extreme here. In fact, if I were to take this out, take this out really quickly, and then set up standard deviation. I'm going to put this into there and then change it to volume. Sorry. Standard deviation channel. Put it into volume. Change it this to volume. Get rid of the middle line and the lower line. And then come here. Come here and show the volume. Okay. So, and here, let's go back to, let's do 4. Okay, well, let's do 5 and see what 5 would be. Okay, so we're going to end up with 5, we're going to end up with 5 standard deviations of volume this week. More than likely, we will end up with 5 standard deviation amount of volume this week. That's a huge, huge, huge amount of volume. Closing at the low of the week, that would be significant. That would be very, very significant in terms of like a capitulation type sell-off. And like I said, from a daily standpoint, you can see yesterday's was 5 standard deviations, but it was all bearish. See, that was 5 standard deviations, but all that volume was bullish, right? So that wasn't a capitulation sell-off because it was all bullish volume that day because most of the selling, it was a down day, but most of the down part occurred overnight. During the day, it was all buying because that's the open candle there. So it was a lot of buying volume. This was all bearish volume. And if we close near the low of the day today, that would be all, and still end up with this inside candle on the Harami on SPX, that would be another, capitulation type sell-off. And it would be on a weekly basis too. With the VIX really high. That would be a very positive thing going into next week. Right? In my opinion, it would be a very positive thing going into next week. I showed you before. Did you guys see that tweet? And then I'll show you the McClellan oscillator here. But did you see this tweet too? If we rally today, I don't think we're going to rally very much, Bill. It's going to depend upon if we get 275. I mean, it would be all right. It would be all right. We would get a long lower shadow, a little bit of a long lower shadow. It wouldn't be as good. But here, I'll show you an example of that. Here, I tweeted, it was earlier. I was up late last night because you just can't pull yourself away from this kind of stuff. There's the volume discussion I had. Where was that? No. Where was that chart? Right here. Okay. So here's 2010. The last time we were 20% below the 30-day moving average was October 9th, 2008. That was the last time we closed. And you can see we closed 2 days below it. Very similar to what we're doing right now. We closed 2 days down, nearly 20% below the 30-day moving average. And the blue line says that's where we're at right now. Okay. You can see the next day, so that was a Thursday. Hey, yesterday was Thursday. This was a Friday. Look at that big doji pattern right there. We had a 3-point candle. We had a 196-point range from high to low, but we had a 3-point body. And the 96 points was on, I mean, if you look, we closed at like 899. All right, we closed at 899. So we had a more than the range was more than 10%, more than 10.5% of the price. It was a huge range in one day. So, the S&P right now is at 253. So imagine there being a 25-point range. That would be equivalent to a 25-point range right now. And today's range is relatively big, but it's only 14.5 points up here. So consider 25 points. That's how big the range was back here on that day. And we finished with that size of a body, about as Harami as you can get. The Monday afterwards, So we didn't close at the low. We had we kind of came off of the lows there, but it was pretty bearish. Came off the lows. We ended up closing, 20% below the moving average again. That next day right there, the third day, the market rallied on Monday, 11.5%. 11.5% in one day. Remember, the markets fell 10% yesterday, and we rallied 11.5% that day. And again, we didn't go up to new highs. We only went up one more day, and then we came back down and tested lows multiple times, and then we rallied again really sharply, and we retested lows even worse in November. So it's like, yeah. So then we make bearish trades. Exactly, Bill. Exactly. Once we do pop back up here, if and when we do pop back up here and we get up, say, to 290, we get up to a gap, and we get up to that volume node, maybe fill in this one too and get up to 304. If that's how far we get up, then we would be doing bearish trades out the wazoo, because we're more than likely to come back down to 250. Because there'll be something else that the market's going to be concerned about, another element of uncertainty that will crop up, and we'll retest those lows, because that's what happens. And, maybe it's going to be economic indicators coming out there negative. Now it's going to be kind of an uncertainty about how, what kind of impact it's having on the economy. So that way, or earnings, there might be some earnings that are negative. So we'll retest these lows, and then we'll come back up again. Okay. So I did want to bring up this indicator, and I've talked about this before. It's on that pinned tweet on the list, and that's the McClellan oscillator. Oops, no, I don't want to delete. Load. McClellan oscillator. And here is this. I'll just talk about it here for a second because we're almost out of time. The McClellan oscillator has been extremely low, right? We've been below minus 100 on it. And what the McClellan oscillator is, this kind of quick definition, it looks at advancers versus decliners. And what it does is it says, okay, how many advancers are there compared to, and how many advancers minus decliners, right? How many advancers minus decliners? And then it can take that number and compares. So if it's negative, that means there's been 100, there's been less advancers than decliners, a negative number. So then it compares that number to the total amount of issues, in this case in the New York Stock Exchange. You can see over here on the left, the New York Stock Exchange. Okay. So with that being said, what the McClellan oscillator looks at then is it's a MACD. This is a MACD histogram. And the moving averages it looks at is the 19-day and the 39-day exponential moving average of this number of net advancers, this ratio of net advancers to total issues. Okay, that's what that. So this is a MACD, like the MACD is. And so when we get to negative 100, that's a pretty significant deal. You can see it was over here. It was over here a couple of times, and then we diverged, and then it was here at the end, and then we got that breadth. I think this is when we talked about it over here at the beginning of the year, because we talked about the breadth thrust right there. And when we went from negative 100 to positive 100, that was a sign that we were kind of done with that selling. We didn't quite get a breadth thrust over here, and so it took a while. So now the question, but we did get, you notice we went from 100 up to 0. We went from negative 100 up to 0 in this case a couple of times with that divergence especially. We went from negative 100 up to 0, so we had a rally. So that's kind of why I'm saying in the short term, we've been negative 100, and at some point in time, we're going to run our way up back to 0. It's very similar to trend. Very similar to trend. It's a little different calculation, different way to graph it, but very similar. We are negative 100, and we've actually diverged a little bit because we got much lower lows, and we didn't quite get lower lows here. We're kind of equal lows. But a little bit of divergence forming here, and I expect that we will move our way up to 100 again, which means that we will get this is a 19-day and 39-day moving averages. We're going to get periods, daily periods with a lot of advancing issues, in order to get that MACD back to zero. So whether it's today, whether it's next week, we're going to have a lot of days like that here. We're going to have at least a few days that will bring this now. Will it go very far up above zero? I don't think it will, right? I don't think it will get very far up above zero. In fact, like I said, you have to go back to, let's go back. I don't know if it allows us to, but let's see how far we go back. And thanks for coming on, Jerry. We're just about done here. And it doesn't go back to 87, unfortunately. So we have to kind of go back to this 2008 period right here, because this is very similar to 2008. So here it is. Here's the October, right? There's October 24th when we got the VIX to the highest, to that 70, above 70 print. Okay, so we got below 100 on that October the 9th. That was Thursday, right? This was Friday, and then that was a Monday, and that's the 11% rally we had on Monday, right? Well, we got to minus 100. We went all the way up to zero, but then we retested lows. And then we had a positive move, which is right there. That's the kind of thing I expect here. I expect that we will come back up to zero, not to go up very high, something like, barely above there. We'll most likely retest these lows, but with a much higher low point on the oscillator, right? Much higher low point on the oscillator. And then we'll get a good thrust up higher. I don't think we're going to get a breadth thrust this go around. I think it's going to look more like this period where we get this jump up higher, but not huge, right? It wasn't really until you had, here's your breadth thrust, when you went from negative 100 to positive 100 on the rally. That was your breadth thrust, and that was, we're done, right? So we'll talk about the breadth thrust if and when we get one, but it wasn't over here, and I don't think it's going to be here either. I don't know if we'll retest, low, or we'll go to much lower lows like we did in March of 09, but I do think that we will come up. As the MACD hits zero, we'll retest these lows, and then we'll make a more of a positive run where that MACD, the intermediate line, will get close to 80, but still won't be done yet, because I think we're headed to we're getting a death cross right now. Really, really close. We're really, really close to getting it. We're going to definitely have a death cross next week where the 50-day crosses below the 200-day. And then it's going to be a long time before we get a golden cross. It's going to be a long time before we get, I'm talking months. Doesn't mean that we'll go much slower, and that's what yesterday's class was about in portfolio management. But it's going to be a while before we really get going again and retest these highs and get going again. But that's okay because, the long-term returns are going to be outstanding. I mean, shoot, just to get a 20%, if we were to come off of this 20% low point, right? If we were to come off of this 20% here, so where's my calculator? Just to kind of give you an idea of how long it's going to take us to get back up to and retest those highs. We're at 25.18. A 20% move gets us to 30.21. That will be right here, right? And then another 20% gain off of that would be 36.25. So I mean that would be more than 2 years to break through these highs. Okay. All right. So McClellan oscillator. Again, it was the beginning of the year where I kind of talked about that. Back in this period where we had that breadth thrust. I don't think we're going to get a breadth thrust this time because breadth thrust means that we're going now, that we're done with the low point. It'll be like this V bottom. You can see that's what happened over here. It wasn't quite below 100, but it got below 80, and we went up to 100. That was your breadth thrust that really got things going. So at some point in time, we will pop up and pop up above 100, and that will be the sign that we're going. Now we're moving, but it's going to be a while. But at least we're going to get up to zero. At least we're going to get up to zero, and we're going to end up with a positive, and hopefully a harami here this week, and then a really positive move probably next week, as soon as next week. All right. Well, that wraps us up for today. again, thank you all very, very much for coming on. It's a fascinating time. Someone mentioned before they've learned more in the next couple of years. I'll be out of town. Well, I don't know. We'll have to see, Linda, if I'm actually out of town. We're kind of working on our plans for next week. Obviously, things are changing, so we might end up having the Q&A because I might not end up going out of town next week. Most likely now, I actually won't be going out of town next week. So, but we're kind of working through that right now because we had plans, that we've had plans for months now that we're having to change up. It was our last vacation with our oldest son before, obviously he leaves here and after he graduates for Omaha for a couple of years. So now we're having to change, and so yeah, we weren't going to be in town. We weren't going to be in town this next weekend. So, but if we are in town, then I end up having a Q&A. And there won't be a Q&A tomorrow either because I am out of town tomorrow. Or headed back out. So yeah, someone said that they learned as much in the last couple of weeks than they did in the last 5 years, and that's the case. Like these charts teach so much, and and again, we will see another period like this in the future. There will be another period. Who knows when? But there will be another period like this in the future, and we'll know how to handle it because you've lived through it, and you understand, and you understand how these charts work, and we'll be able to take advantage of this one too because we're learning together right now, and we're going to handle it together. So yeah, you do learn a lot during these periods, and volatility equals opportunity. Always, 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 volatility equals opportunity. So we're going to take advantage of it and use it for opportunity. All right? Again, thanks, everybody. Have a great rest of your Friday and your weekend. If I see it, we have Market Outlook Live at 3:30, and then I'm leaving actually after that. I'm trying to do I might end up doing the Market Outlook a little earlier. I might end up actually recording the Market Outlook before the market actually closes, like right after I do the live session. So we'll kind of see how that goes with Jayhawk. And then yeah, so we'll see you all next week in class. All right. Goodbye, everybody.